Hey guys, how you doing? Your consultant is back, Mr. Craig Jennings. I know we've been gone for some time, but I'm back here to give you guys some huge value. Today, we're basically going to break down some bits, some myths, and some ideas out there about credit that actually just really aren't true. So I'm hoping today that maybe you guys get some more information that you can apply with the credit breakthrough episodes that we've already kind of put up there for you to basically just give you some more value to help you understand credit. And before I move any further, please click that subscribe button or that like button if you appreciate the information and get some value from it. We also would appreciate any comments or concerns that you may have. Maybe you might want to see something specific around the basis around credit, or maybe there's some questions or concerns that you may have, or maybe around the Mythbusters that we go over today, or maybe there's some other issues or some other topics that you'd like for us to go over. So please, if you want to include any of that stuff, we really appreciate all your feedback. Because we want to be the best value for you. So we're going to continue on with the video today. So today we're just going to do Mythbusters. So we're going to go over 10 major credit breakthrough Mythbusters out there. 10 things that people think that are true that just aren't true. Hey guys, so remember, we're going to go over 10 Mythbusters out there. 10 things that people feel like that are true about credit that absolutely, honestly, just isn't true. The first thing we're going to talk about is paying off loans. Okay, so the myth out there is paying off your loan early will help boost your credit score. I'm here to tell you that that's actually not the case. When it comes to credit, the two major factors that drive your credit score that you would have saw in my second episode of the Credit Breakthrough would be payment history and credit card utilization. Now, loans such as mortgages or auto loans or personal loans or even debt consolidation loans, those amount balances actually are not included in your credit card utilization. So therefore, to pay them off early wouldn't actually give you those same benefits as it would as opposed to paying off a credit card in full. Secondly, whenever you close a loan, in terms of a home, auto, or personal loan, what happens is the history and that equity and all that payment history and all that reoccurring payments that you've made on time, showing the lender that, hey, I'm going to pay this money back, I've paid it back on time, I've done my due diligence, you lose all that credibility, all that equity, all that history when you close your account. So one thing that I really preach to my clients is it's important right now, in order to leverage your credit, to really just focus on your credit card utilization and not so much on the other debts. And to be honest with you, some debt actually isn't bad. A mortgage necessarily isn't bad. It's not necessarily bad debt, and it's not viewed as bad debt to lenders. So therefore, there shouldn't be such an urgency to pay them off. I feel like if you really want to leverage your credit score immediately, then you really want to get down your utilization. So that is the first of the Mythbusters. And like I said, guys, really, ideally, you never want to close an open account sooner than you need to, because you lose 4 out of the 6 things and items that really drive your FICO 5 credit score. Hey guys, so now that we've gone over the first myth, I'm going to go over the second myth. And the second myth is kind of similar to the first one in terms of closing down the account. So this is the myth. I've been told by people that, hey, you know, I had this $10,000 credit card. Like, so let's say, I'm gonna give you a perfect example. One of my clients, he has a $10,000 business, a $10,000 credit card with Wells Fargo. It has a $7,000 balance on it. He hasn't paid it in 6 months. So what happens is now it's with collections, and they are asking for their money back. So collections gave him a deal. They said, look, if you pay for $350 or half of the balance that you owe, what we'll do is we'll close the account down for you, and your account will be made as full, and you'll be good to go. This is a very, very bad thing. Okay. Anytime you work your hard-earned money and you put your hard-earned money down on a credit card to pay it down and give it back to the lender, you then at that point, you are very vested, right? So now you spent $300, $400, $500 to pay off that debt that now no longer is a credit to you once you pull it off your credit score. So ideally, in those situations, we want to be able to come up with a deal and then somehow try to keep that line of credit open. Now, I know what you're thinking to yourself. Well, you have all those bad things and those stipulations and all those late payments, and I get that. But once you close that account, now all the positives in terms of credit age and history and having an open account, you lose that when you actually close that account. So I try to tell people, when you're working on paying down your credit cards, the credit card companies are going to offer you to pay off the card. Excuse me, they're going to offer you to close the card because of your delinquencies. To them, it's like, we'd rather offer you closing the card so we don't have to worry about you owing us money. So really, ideally, like, you really never ever want to close a credit card account, even if you're not using it. Generally, when cards are idle, you have to use them once within a 2-year period, which is actually pretty cool. So that means you can open a card, use it twice, and never have to touch it again, and it still shows as viable on your credit score. So you definitely never want to close a credit card if you can help it. I know that there's some situations where you've gone too far in collections and there's no going back. We can kind of discuss that later, because I think that kind of depends on the person and the time and the place and what their situation is. But at the end of the day, you never want to close a credit card account if you can help it. And that is the second myth buster that we're going to go over today. So the third myth that we're going to go over today will be bad credit. I've had a lot of people come up to me and say, I have bad credit, I have no way of coming back, so I don't care. That's actually not true at all. Once you have bad credit, I know it can be defeating, I know it can be scary, but honestly, there's plenty of ways and plenty of resources out there, if you think outside the box and get the right help, that can help you recover your credit score. It's funny that this is one of the myths, because I know I personally went through this myself. I know at the beginning of last year, I had a 590 score myself. As I told you guys in the first video, getting into some credit card debt, not really understanding them. Now that I've got them paid off, I paid them all down, I'm back. I recovered all of my accounts. I didn't close any of them, and because of that, now that I'm paid in full, I went from a 590 to 720, and I did that in a matter of a month. So there's no such thing as having bad credit and not being able to recover it. I think there is such thing as being financially educated in terms of what it looks like and what lenders are looking for and what really drives your FICO credit score. But just so you know, no matter how bad your score is, it can always be recovered. From bankruptcies to collections to old debts to late payments, all those things can be corrected with time and energy and the right knowledge and the right application. And that's why I'm here. The fourth credit myth I want to go over today is checking your score. A lot of people have a fear that checking their score is actually going to hurt their credit score. And I'm going to tell you that is false. Now, there are a ton of websites, ton of apps out there that will give you a barometer of what your credit score is. I could sit here and probably spend 30 minutes on giving you guys information on places where you can track them. And to be honest with you, as time goes and as I've grown in this space, I've noticed that every credit card that I have, if you go to their apps, they actually have a FICO score in there for you. So there's a multitude of ways of tracking your credit score. There's a multitude of ways of seeing where you're at. There's a lot of myths that your credit will get hurt by this, and this is actually absolutely not the case. The only time your credit gets affected from you checking it is through inquiries, and you generally only get inquiries when you put in applications for loans, for credit cards, etc. So actually checking your credit score doesn't hurt you at all. I know that using Credit Karma is an app that I use a lot. It's something that I put on my clients a lot. I know there's also some other paid apps out there like Experian that also give you a ton of information. I know there's Nav. There's a ton of apps out there that give you some good information in terms of where your FICO score is. But I think more than just understanding that checking your score won't hurt it, I think it's also good to understand too that, guys, your credit score fluidly moves. As you go through the months, as you're paying down cards, as you're adding balances, as you're adding accounts, your credit score changes and it moves. So don't get frustrated when you look at all these sites and see that your score is actually different everywhere. Remember, they're just raw measurements and approximations of where your credit score is. Nothing out there is really going to give you that exact number, which is fine. We just want to know the ballpark range. And I feel like Credit Karma does a really good job in giving you probably your closest estimated guess to where your credit score is. So with that, does checking your credit score hurt your credit? No. The only time your credit gets affected is when you actually apply for something, you put an application for a loan or a credit card, etc., and they pull your credit. That's the only time that your credit gets affected, when your credit score gets looked at. All right, guys, so now we're on to number 5. And number 5 is and this is a good one. I love this one. It talks about your score. So there's three major companies that follow and track your credit that get reported to by borrowers and lenders. It's Experian, TransUnion, and Equifax. Now, the myth here is, well, only one of those scores get used for everything. Every time someone applies for something, they only use one of the scores. That's actually not the case. All three scores can be used by any point in time. And actually, there's certain lenders that only use one particular score. So, for example, Discover might like to use TransUnion a lot. They might pull up TransUnion every time you apply for something through Discover. Whereas American Express, I know that they love Equifax. They use your Equifax score to kind of determine whether they're going to lend it to you or not. So it's important to understand that all three scores are vital, but no one score drives more importantly than the others. It just depends on who you're asking to borrow the money from. Now, in later episodes, we will kind of dig into what companies like to pull from where, so you have a good general idea. And also, too, later on down the road, when it comes to applying for credit cards, it helps you out with inquiries. For example, if we know that American Express, let's just say Discover and Chase, if we all know that they like to use Experian, well, when you apply to one card, it might be smart to apply for the other two within a certain period of time, so you only get the one inquiry under that one particular company or that particular credit tracker. So if you were to apply for a bunch of cards that all report to Experian, where you're only going to see that one inquiry under your Experian line, and it won't affect your TransUnion line or your Equifax line. So I know that kind of got a little wordy and complicated. That's why we got the comments down below. That's also why you got your boy here, consultant here, ready to help you out. But just to kind of explain that the way it works, all three scores are used. It just kind of depends on what lender and who you're borrowing your money from. The sixth myth bust I want to talk about is delinquencies with loans and credit cards. So it says, once a loan is delinquent or a credit card gets paid off, it's removed from your credit score immediately. This is actually not true. And what I mean by that is collections. So when you get to collections, and let's say you owe someone money with a loan or a credit card and you were behind, and now you were able to kind of find that money, maybe you saved, maybe you're on a journey to get your credit corrected, so you've been saving money to pay off this debt. And what happens is a lot of times is people get on the phone, they get these things paid off, but then they don't ask the company to remove it from their score. So anytime you talk to a collection agency or you're trying to get your credit card or your loan back up to date and you're going through this process of paying off these old debts, you need to make sure and ensure that they take it and remove it from your credit score. For example, I had a client of mine who paid down a $2,000 collection debt. They paid it in full, which is great. They wanted to pay it because they want to buy a home in the next couple of years, and they understand that getting that collection off their score is going to help their credit score a lot. But in that process, they didn't make sure that their creditor removed it from their score. So 2 months after paying that large amount of money, they were expecting their score to take a jump. However, the company never removed it from their credit profile. So we had to do a dispute. We had to file some forms. Great thing about it is I know how to do all that stuff. So we were able to kind of get it removed eventually. But it's definitely something I want to warn all you guys about. You need to make sure that if you have some old debtor collections that you're paying in full to get your credit score back up to date and to get yourself back into the green, you need to make sure that they pull it off your score. Because you can pay all the money you want, if it's not removed off your credit score, all that money and all that energy was for nothing. That's not good. All right, so the seventh myth out there is paying for cash. So the seventh myth is, instead of using my credit cards, I'm going to pay everything in cash. Okay? Now, the reason why I say this is a myth is because there's nothing wrong with using cash, and I think that you shouldn't really purchase items on your credit card unless you have the money available. However, all your credit cards that you want to keep open, you will have to use them at least once every 2 years. So that's one factor. Secondly, when you use your credit cards, that doesn't mean you have to have a balance on them. So it's okay to pay for something, use the cash that you were going to use to purchase it, and just use that cash and pay off your credit card. The reason why you want to do this is because you want to keep your cards active, one, and then two, there's actually a lot of cash rewards and other rewards and benefits that you can gain from using your credit as opposed to your cash. Now, am I by any means saying that you should run up your credit cards and not use the cash that you're getting in every month from your paychecks. I'm not saying that at all. I'm just saying that staying with cash only and staying away from your credit cards is actually just a fear of not understanding how credit works, okay? Now, I know we talked a lot about utilization and keeping it low. I know for me, myself personally, I only use credit. I don't use my debit card for anything, and I rarely ever like carrying cash on me. It's just dirty and it just gets messy, and I just don't like using it. So really, I use credit for everything. I can go in further detail on why, and please leave your comments down below if you have any types of opinions on this. But I think that utilizing your credit, paying things through credit, paying off those bills before the deadline, before interest accrues, before your bill is due, I think is very viable in helping build your credit. And like I said before, I know that it's a very scary thing, but I think people are just afraid of it because they don't really understand how credit works. So is using cash instead of credit cards, is that really going to help boost your credit? No, not really. You need to exercise your credit cards. You need to have them active, and you need to show that you can not only use your credit cards but other loans in multiple ways as well. So you don't want to just stick with cash. I'm not saying paying with cash is bad. I'm just saying you want to be diversified and you want to actually help understand what credit means. And we're going to go down this further down the road in terms of cash rewards and bonuses and things that actually you can get for free from just using your credit cards. But that's going to be later on down the road. So just let you guys know, just because you use cash instead of credit cards does not mean it's going to keep your credit necessarily safe. It depends on paying down your credit card bills, paying your payments on time, making sure that you're not late to any loans or any money that you're borrowed. That's what's going to help build your score, not necessarily substituting cash for credit. Hey, and one last thing I wanted to add to my last myth that I forgot to mention is just security. So for example, I've had debit cards now. I've had a job now since I was 18 years old. I'm 34 now, so I've had checking accounts, a lot of different debit cards and whatnot. And I think I've gotten my debit card information stolen like 7 to 10 times, where someone goes out there, they steal my debit card information, and they ransack my personal savings, they ransack my checking account. You gotta wait 7 to 10 business days to get that money back from the bank. It's a real hectic headache. You don't have any access to your funds. You can't spend money because all your money is tied into that debit card. So in order to avoid that, I like to use credit instead of debit. Whereas, say for example, I go to a gas station, I use my credit card, they steal my identity. Well, I go through the same process of getting my money back on the credit card as I would on my personal debit card. And in that process of getting that money back, well, now I just won't use that card. I won't use that card until all that money back and everything's fixed. I'll just use another credit card instead for my major purchases, and I continue on with my day. All my money's not tied up. I'm not waiting 7 to 10 business days to get the large amount of my funds because I just can leverage another card. So that's another reason why I generally tell people that it's good to use your credit cards instead of using cash or your personal debit card, so all your funds are tied to one spot. So we're going to move on now to the 8th Mythbuster. And the 8th Mythbuster is, my credit score can't hurt me getting a job. Now, a lot of people don't know this, but sometimes when you put an application for a job, depending upon the company and where you're applying for, or what position you're applying for, when they go through the background process, actually your credit score does get pulled. And the reason for that is because they want to make sure you don't have any major debts or anything, or any major deficits. They also want to make sure they check your criminal history, etc. But through that process, some employers will actually pull your credit score. So, I'm not saying that you won't get a job if you have a 600 credit score, but ideally, like if you're looking for a bank job and you have a 500 credit score and you're $200,000 in the hole, they might look past you because they might say, well, there might be some reason that he might want to steal, or maybe there might be a reason why he might be fraudulent because he's in all this debt and he's looking for ways to get out of it. So it's an unfortunate thing. It doesn't happen with all employers, but I do know that there are some employers that actually do check your credit score when it comes to applying for a job. So it's just another great reason to work with us and to help keep your credit at a great level. So one, you save money and you have great leverage, but two, it opens up doors, it doesn't close them for you. All right, guys, so here comes myth number 9, and this one really got brought to my attention recently, and I feel like I needed to include this in the video. So I had a buddy of mine who's trying to help his brother build credit. And the first thing he said to me was, I want to add my brother to the gas bill so we can start working on his credit. That is something that actually does not help your credit score at all. Actually, utilities only hurt them, and I'm going to explain that. So there is a thought out there that paying your water bill on time or paying your cell phone bill on time will help build your credit. That's actually false. When it comes to utilities and basic bills like that, they can actually only hurt your credit score. They don't help it. The only time things like that get reported is when you don't pay your bills on time. So if you go 4 months without paying your credit card bill, they feel like they don't get the money from you. Well, they're going to send you to a collection agency, and now that collections is going to be put on your credit score. Whereas if you just paid those cell phone bill payments on time, that none of that stuff gets reported, and you're good. So utilities actually do not help your credit score. Now, I do know that Experian out there, who was one of those credit tracker devices that we've talked about in a couple myths ago. I do know that they have a program out there that they promote for for a boost on your credit score. They call it the credit card boost. And basically what it looks like is they want you to attach your utilities and have them directly report to the credit bureaus themselves instead of not reporting it. And the reason why I don't necessarily recommend this is because I believe that when you get paid and you get your paycheck from your employer and you get your salary and you get your income every month, I think it's very important to pay yourself first, right? Pay yourself first in terms of credit card, your savings, instead of paying your utilities first, because utilities don't directly affect your credit score the same as your auto loan, your home loan, your credit card bills, etc. So I don't necessarily recommend this because I feel like utilities is something that we all kind of pay on time every month, even though really the only purpose of paying them on time is to keep those utilities on, which is obviously is important. However, it does not affect your credit to the degree that you believe it does. Your loans, your credit cards, however, do. So my suggestion is whenever you get paid, say you got a $1,000 check, you take 10%, you put it away in your savings for a rainy day, because all of us should have anywhere between 3 to 6 months of your monthly income saved in case of rainy day, in case of emergency, in case of COVID-19. So you want to have that money saved. So you want to put your money away there. Then you want to take your bills, like your credit cards, your loans, and all those things. You want to pay those things off immediately before they're due. So you want to pay those secondly, and then you pay your utilities. So really, utilities and other miscellaneous bills like that should be the last things that we pay. We should definitely be paying ourselves first, and then also focusing on the things that directly affect our FICO credit score secondly, before we pay utilities. So once again, the myth out there is that utilities help build your credit. That is absolutely not the case. Actually, utilities only hurt your credit score. They don't help it. And the 10th and final myth that we're going to go over today is credit is impossible to get if you don't already have it. Now, a lot of people think that it's really hard to get your credit established if you don't have credit already established. That's absolutely not the case. There's actually a multitude of ways to kind of get you off the ground. There's authorized user hacks. There's also secured credit cards that you can apply. There's a multitude of ways to kind of get yourself off the ground in building credit. And this course and our consultations, we definitely go into those things in the great detail because it kind of depends on a case-to-case basis. But please, please, please do not think that just because you don't have any credit established that you cannot gain any credit. In fact, I have some programs and some cards in mind that are specifically created to help people build their credit profile, to help people get going on the fast track to building their credit, as long as they make those payments and pay back that money that they borrowed on time. So it is absolutely false. Once you start in the credit game, there's nothing necessarily holding you back. You just got to understand the rules behind it so you can leverage it to your advantage. Just one fun fact that I'm going to give you guys for free today on this video is actually building credit for your children. So I don't know if you guys know this, but most lenders out there, most credit card companies out there will allow you to add your children as an authorized user starting at the age of 14. So you can actually help your children get off to a great start in their own credit lives and teaching them how to build and how to keep their credit before they're even 18. this is one way to kind of get around this myth in terms of not starting with credit. So instead of having our young ones and our youth and our children start from the bottom, kind of how we did, there's ways that I can show you through our program that you can actually help them get off to a fast start. Because how much better in life will they have, or how much more opportunities will they have in life starting out with a 700 credit score at 18 as opposed to having to start brand new. I know for me in my own personal life, when I first started establishing credit when I was at the age of 20, I went to purchase my first car. Now, in order to get in that car with barely any credit established, I had to put a large substantial down payment down, and my interest rate on my APR, my first car loan, was actually 12%. 12%, because I had no credit established. Now, whereas if I had a 700 credit score and we went through that same process and the same story lined up, I wouldn't have had to put nearly as much money down on the car. And instead of walking out of there with such a high interest rate, I probably could have got out of there with a 3-4%. So obviously, as you can see, there's great benefits to having some established credit when it comes to applying for loans and things, because long term, you're going to save more money because the companies feel like you're going to pay them back. So you're going to get a better rate. You're going to save money on a monthly basis, just because companies feel more comfortable with lending to you. So it is not impossible to build credit if you don't have any. It's just a matter of understanding it, and that's why we're here. That's why you have the consultant. Hey guys, so those are the 10 big credit myths that we went over. Like I said, if you have any comments, concerns, questions, please leave them down below. We really would love your feedback, and I will answer any question or any DM or any comment out there. I will definitely make sure I get back to you. I hope you enjoyed the video today. You know, we gave a lot of great value. There's a lot of questions and concerns of how to work and how credit works and how to get it to work for you. And like I said, I will love to go into great detail with you if you leave a comment or subscribe or like down below. We'll make sure we get back to you. So once again, thank you for watching another episode of the Credit Breakthrough. I know the first couple episodes are really just kind of teaching you the basics of how credit works. Today we kind of went over some myths and things that I've come across with my clients while helping them build their own credit. And definitely keep an eye out for some future content from us. We're definitely giving a lot of value out there for free. We want to make sure that, like I said before, we want to create a financial advisor in every household. That is our ultimate dream and goal. Thank you again for watching. I really appreciate it, and see you soon.